Hello and welcome to Halftime Report. I'm Ekta Batra, with me is Mangla Malu, and we do have the WPI data which is on your screen for the month of May. It's come in harder than expectations, so 2.61% is where it's come in versus 1.26% on a month-on-month basis. We have Lata in the studio back with us after quite a hiatus for WPI. Lata, over to you.
Yep. The fact that this number would be positive is not a surprise. My poll was 2.4, so it's not terribly shocking. But you're right that it's coming in after about 15 months of negative number. Now, that is where the hint is. What was May WPI 2023? Minus 3.48. It was about the peak. Actually, June is the peak, when peak as in the bottom. It had gone, I think, to minus 5 in June. So we are going to get higher WPI numbers starting now. But it doesn't look like it's very high. Imagine if it is minus 3.48 at 2.61, assuming the base is 0, we are getting something like a 5% or a 6% WPI. We have to watch this carefully. We also have to look at the fact that the metals prices have been rising globally. Right. The CRB index, I was looking at it, the commodities index, that one has risen year on year by about 17%. And about 55% of the WPI, our WPI index is impacted by these kinds, by commodity prices. And therefore, the core WPI also would have gone up. As you can see, manufactured products inflation is finally showing a positive 0.7 over a minus half or something year ago. Food inflation is obviously higher year on year. There it was not all that negative even year ago. And that's risen. Look at the potato numbers. All this is base effect. You have to, cut a lot of slack on it. Do we have our guest, Aditi, with us?
You spoke. Okay.
Yeah, go ahead.
You spoke about the metals bit. We have some data out there as well. Basic metals index is up 2.9% on the month. So basically, month on month, there's an increase of around 3% out there. You did speak about core inflation. Core inflation too has turned into a positive trend, 0.4%. This compares with minus 0.7% in April itself.
Absolutely.
So month on month, there has been a move towards the positive terrain for core inflation as well, and all of that is reflected in the overall WPI.
Actually, you can go down that entire list, manufactured beverages, tobacco, textiles, every one of them is showing a month-on-month rise. So we have bottomed out as far as WPI is concerned. Just a very quick word before I go to Aditi. The GDP and the GVA numbers have been looking good because the WPI was negative. You didn't have to deflate it much.
Yes.
You counted nominally, you didn't deflate it much, so we got a very good GVA. Now you have to start deflating it with a WPI because the GDP has about 60% deflated by WPI and only 40% deflated by CPI. So a rising WPI will now have an impact. The GVA number will not look as good as it looked in the year before because the statistical deflator is going to be higher. But let me very quickly go to Aditi Nair, the chief economist from ICRA. Aditi, what have you made of this 2.61? Are we now going to have a rising trend of WPI?
Thanks, Lata. Actually, our number was a little bit higher. We were expecting the WPI to come in closer to 2.9%. So I suspect some of the commodities, the base has caught up, but the actual month-on-month rise may not have been fully factored into the initial numbers, which is something that we see quite often with the WPI. There is a lag with which we see the transmission that is happening. But globally, the trends are quite visible. The Bloomberg Commodities Index is pretty much at or higher than the year ago levels. Freight rates have been rising. Domestically, food inflation is showing a little bit of a mixed trend while the monsoon has started off early, but it's scorching hot in the north, and that is definitely something that will have an impact on the perishable prices.
Aditi, 1 minute. I take your point about food and vegetables, which inevitably rise in June. But core inflation in CPI was like a dismal 3.1. And in fact, there are some economists who were even saying that by their calculation, it is 2.97. So won't that also dampen WPI rise?
So, Lata, I think a couple of things we need to keep in mind when we project the CPI core inflation going ahead. Last year, we were in a kind of Goldilocks for the Indian economy as far as the commodity prices were concerned, where we saw global commodity prices were lower, significantly lower on a year-on-year basis in many months of FY24. And that is something that helped to keep the prices of final output in check in India. And that's something that actually ended up dampening the core CPI inflation, particularly in the last few months of FY24. Now, perhaps the reverse is going to be ahead of us.
Okay.
Obviously, we're not expecting a spectacular rise in commodity prices the way that we saw during the onset of the Russia-Ukraine crisis, but commodity prices do look like they're going to be harder than where they were a year ago.
Yeah.
And so I think that will seep into both cores.
Okay, okay. Just if you can give me one number, what are you expecting WPI in either this quarter or this year?
For FY25, we're working with 3.3% as an average for the WPI and 4.6% for CPI.
Okay. We'll leave it at that. Aditi, thank you very much indeed for joining us with your quick take on the WPI numbers. Slightly higher than expected, but it could get a little higher. As Aditi says, this year we may average closer to 4%, between 3.5% and 4%. It will have a minor impact on GDP also. That's very important to remember.
Doesn't have a much impact on what the RBI does, but you know, we had Chetanaya say that this year he has factored out any rate cut. Would you think, you know, the CPI would have an impact as WPI is increasing, maybe CPI increases with lag?
But no, of course, the inflation target is all important for them. It will have an impact. But actually, at this point in time, we have to monitor what difference the Reserve Bank wants between nominal interest rate and inflation, the neutral rate. That is becoming all important, and we will know that in the RBI bulletin. But I believe we have a very important guest waiting by immediately after this break. We're going to go into a quick break. Manish Chokani, Director, NAM Holdings, will be speaking with Anuj Singhal.
Hello and welcome to this special episode of Market Masters on CNBC-TV18. My guest today is what I call an all-rounder, someone who is an economist par excellence, a stock picker and a gifted singer. Yes, we're talking about Manish Chokani, Director of NAM Holdings. Manish, thank you so much for joining us here.
Anuj, I only agree with the third one, not the first two.
The third one you can't disagree also. For those who have seen or who have heard your songs, it's, you know, yesterday in fact I was hearing your song and, you know, it felt like Hemant Kumar had, you know, just come back into the world and he was singing. It was that good. But no, Manish, you are being modest. I think you're someone who has, you know, a good pulse of both macroeconomics and picking stocks at right prices. I'm going to start with the macro because that's what is most important right now. We have had an election in which the market, in the end, perhaps got what it wanted, but there was a bit of a scare.
Of course.
So how did you read that outcome, and does that change anything for the market?
No, well, the markets already voted that they think it now is continuity. And while the outcome wasn't what the market expected, I think the market had baked in that there will be at least a simple majority of the ruling party and the NDA will come back with 300 plus. So this lower number of seats certainly spooked everyone. And then when the realization dawned that it's two very senior coalition partners in Chandrababu Naidu and Nitish Kumar, who are both probably towards the end of their career and little bit more likely to be statesman-like and looking for development of their states rather than what they can extract for themselves or their families, I think the market has calmed down a lot of it. And remember, Chandrababu was the original CEO CM who put the whole developmental plank and agenda in front of the country. So I think on balance, markets taken it well. Policy continuity looks to be, you know, in place. Of course, things will be a little more contentious because the breakup of parliament is now not so one-sided. And maybe in its wisdom, that's what the Indian public wanted, that there is some checks and balances. While we still, you know, like what has happened, maybe that's really, you know, what was desired.
We want PM Modi, but not with the brute majority.
Absolutely. So maybe, I don't know. I mean, we are reading now post facto.
Post facto, yes.
But maybe that's what really in its wisdom the Indian public seems to have wanted. But doesn't seem to distract from the fact that, you know, what was achieved over the last 10 years in terms of fantastic infrastructure development, very, very great national security, internal security, the great speed and transparency of what was happening on administrative, IT, the digitization of India, the GST reform. So a lot of good things have happened. And one is expecting continuation of that to make, as I say, velocity of doing business in India faster and easier. And that's really what the market seems to be signaling and the world seems to be expecting from us.
Okay, since we are on the topic of macro, a couple of other issues that I want to discuss with you. currency volatility in India has completely died. You know, it's almost as if the currency market on a day-to-day basis is not trading. And B, we have seen continuous FI outflow, at least from the secondary market, and that gap being filled by the retail investors. What do you make of that?
No, so two things. On currency, it's a different game because what the West has continued with its printing, and even while the central banks signal that they are doing a reversal of quantitative easing, the government balance sheets have started deteriorating because the fiscal balances are going absolutely crazy. So I don't think monetary tightening is happening anywhere in the world. And that is what is reflecting in commodity inflation or the rigidness of inflation which is happening in the world. And because the world knows there is a lot of inflow eventually going to come into India, the currency is expected to actually appreciate, and I think we are doing the best to keep it down. Whereas other currencies in the region have all started again falling. The Indian currency has remained very strong despite, as you say, some outflow from foreign equity investors. Because inflows on debt side, remember, are going to be very strong. And it's almost inevitable in my view that the equity investors from overseas who are waiting for a break in Indian prices never got it. But any dip in this market, I think there's a wall of money heading our way.
You say that because of the bond inclusion?
Bond inclusion has happened in all the indices, and I think a series of that will continue. And same way in equity indices also, it's almost inevitable that India's weightage starts going up because our the index share compared to GDP share, I think lots more. We're still like barely sub 2% on the indices. And remember, markets tend to vote on future profit potential of our economy. And the Indian economy at 4 trillion and whatever 5% profit share at 200 billion is not the sum and substance of what India will make. So over the next decade, definitely I expect our currency to be substantially stronger. It has to be actually a freely traded convertible currency, and moves are already being tried in that direction. But I don't think that day is very far where you'll be able to go out and actually not say I have to carry a euro and a dollar with me, but hopefully you could go and do all your buying overseas using Indian rupees. But anyway, that's for later.
That's for another day. You said that FI money will soon come to India. When will that come? Because we've been waiting for that.
So, well, I was listening also very keenly to the Morgan Stanley folks who really have an edge on this. But and I was also in Europe, last few weeks. I think the amount of interest in family offices and people with substantial money, and even the retail, because they have all now heard that India is the next thing. And I do think, and I've been saying this for some time now, that India will be a repeat of what happened to emerging markets in 80s when Japan and Taiwan took off. And those markets went 10 to 12 times and became a bubble. Same thing happened when China took off, and that market also indeed went into a bubble and then has been correcting ever since. The conditions are such that India will create a bubble. And maybe retail is kind of smelling it. The institutional investors are obviously, they have to rotate their money as private equity and so on, those are the fellows selling. But when you get a wall of money, and largely it comes through ETFs and passive flows, they tend to be price agnostic. So as and when this happens, and I even read Ashish Chauhan saying that the Japanese have launched a ETF. And the money which then comes, because the wealth in these countries which is earning very, very low yields and doesn't see a lot of growth prospects in their economies is very large. So one can't time it, but I wouldn't be surprised you get like 50 and 60 and 70 billion dollars of inflows coming to participate in a market, which in the context of a $4 trillion market cap is not something so crazy. But it just creates that final climax.
So that is very interesting because Manish, you know what, at the end of the day, the most money is made when you are actually entering the bubble phase, right? Now the issue is, you gave the example of Japan. Japan never touched its highs for 40 years.
That's right.
So are you saying that in next 5 to 10 years, we could be headed that way, that we have the index going up maybe 8-10 times and then for many years creates a
that's both a, how do I say it? It's a opportunity as well as a fear. That the country needs to absorb that kind of capital to use it to grow. So it's possible, because a lot of people know this history the way I do. It's possible that the larger companies then go out and raise $10 billion directly in primary issuance, rather than that money coming into secondary market. That itself would also help to create, in a sense, a real bubble.
absorb some of that.
Secondly, I know our regulators and the ministry also should be aware of this, that you don't, as an investor, even I don't want a bubble. Because you get great returns in a year and then you spend the next 10 or 20 years making nothing. So it's great if it doesn't happen. But all I'm saying is looking at the conditions and the speed at which this market now works and the way the computers are now programmed and the way the flows are into ETFs and passive price agnostic funds, I don't see how, whenever it happens, if it happens, one will be able to prevent this from happening. So the only response, the fastest response doesn't typically come from regulators, it comes from private sector. And my belief is the private sector will participate by raising $10 billion. It could be, for example, it could be a Reliance or an Adani going and doing a $10 billion raise each for one or two of their entities. And that could absorb the capital because capital clearly wants to come into India.
Okay. What about retail? Because, we all through the 2000s and early 2010s, the belief was that retail always comes in at top.
Right.
And this time it's been different and refreshingly different.
But it's even been a top now. So it's rising top, rising bottom. So why do you say retail has come at the top?
No, I'm saying this time it's different because retail has managed to not only come at good levels, but stay put. And the best example was the verdict day when you saw so much buying by retail.
That's right. Yeah, that's actually true what you say, that on the day of verdict, maybe the foreigner was very excited that if things go a bit awry, we can get invested into India. Because by and large, the country will go on its trajectory. And retail didn't give you a chance because that money just quickly came in. So you're right in what you're saying. And therefore, as I say, if retail doesn't let up, and it doesn't look like it will, the domestic money anyway doesn't have anywhere else to go. It will, the domestic as in family offices and so on. And the foreigners are very anxious and desirous of coming in. So anytime they see a small break or with some passage of time, you see that money coming in and there's only buyers from all three sides and there's no seller. That's what I call the conditions for a bubble to get created, which is why I think it's likely. I hope it doesn't happen because bubbles, while they are exciting on the way up, they are devastating on the way down. And then the aftermath is very, very bitter. So I hope it doesn't happen.
But we are still some distance away from that.
So Anuj, what's happened is small cap, mid cap have actually experienced a bubble because some of the prices are just fantastic. I don't think
we are already in bubble.
I think some of those prices people will not see 10 years later. The companies will perform, don't get me wrong. I'm bullish on our economy. I think we get to number 3 and eventually in this century we will be number 1. We will be the largest economy in the world. I also feel there is money to be made in our markets over a decade. We make 3 to 4 times on the index every decade, depending point to point. But if from this point you think on mid cap, small cap, you have to make money, you have to think of a decade ahead. I don't think over the next 3, 4, 5 years, you should be thinking I'm going to make this kind of return here. The index, however, and why we are still okay, is the index constituents haven't really participated. So the larger ones, as I said, the Reliances, the IT, the banks in particular, they haven't participated in this. And that climax finally when foreigners come in and they have to deploy large money, it typically comes into the top 100 stocks. And that's when you finally get the parabolic rise.
No, that's the paradox, right, Manish, right now, because for an investor, you might be thinking an HDFC Bank right now perhaps represents a far better value than, say, a defense stock or an EMS stock. But, an EMS stock has still given you 30% returns in 3 days, and an HDFC Bank is still where it is. So how do you make that decision in that case?
So, look, if I look back 3 or 4 years ago, I remember on our shows we would talk about exactly EMSs or PSUs and so on, and they were dismissed that
the
these
hated
are
space,
inferior businesses, not good businesses, and so on. And it's from those spaces when the earnings get delivered and the surprise comes that the P also changes. So you got a double effect in all the spaces that we talk about. PSUs in particular have led actually this rally. Power, infrastructure, real estate, which were the hated stocks of the last cycle of 2008, have actually led in this rally because in cyclical upturns, these are the types of companies that perform. Having said that, as an investor, you should always be thinking what's the hated space in the market today, not what was great yesterday or 1 year ago or 2 years ago. So from that perspective, again, I draw back to history. Infosys was a great business in 2000. The stock did not perform for 10 years. The business did brilliantly well. The stock did not perform for 10 years. Prior to that, Hindustan Lever has experienced it, where the stock did not perform for 10 years, from 98 to almost 2007 or 8. And similarly, Reliance also, which had led the 2007 bull market, did not perform for 10 years and then it quadrupled in this last period.
Yes.
So a lot of these companies, as I say, they have done well, they will continue to do well, but the stocks may actually not do as well in the coming few years. that gives you a chance, if you indeed want to rotate, to go into something which is a little bit more hated today. Because if this market is going to continue climbing, it's a rotational market. It's not only a sector which can lead. It will keep rotating from sector to sector, and therefore the final climax has to be made where people haven't participated. And the largest money, in a sense, has to get made in financials, because that's where the bulk of the index weight is also.
All right. Well, let's do one thing. Let's take a quick break. We'll come back and resume this conversation with Manish Chokhani. Welcome back. Well, I'm in conversation with Manish Chokhani, and before the break, we were giving you some examples, and just from example point of view, let's look at HDFC Bank, which is right now perhaps, as we would call, perhaps in the hated category, not given any returns for last 4 or 5 years. A stock which used to trade at 4 times, 5 times price to book, available at 2 times price to book. I mean, what's going on here? I mean, purely as an example, and do you think at some point perhaps some big investor would say, okay, enough now, let's just go out and buy it?
See, it happens. I remember the famous case of ITC. 2 years ago, everyone said ESG funds, tobacco, nobody can buy it. Why should they touch it? And it was languishing at 200. Today, it's 430. And it's a large cap. In fact, ITC today, you'll be shocked to know, is the same market cap as BAT, the parent. Same way, a few years ago, there was the dominant narrative that Maruti has no future, small cars are over, EVs are coming.
Yes.
What will happen? Will the company get acquired by Toyota globally? Today, Maruti's market cap is double that of Suzuki. As in, Suzuki effectively has a zero market cap because it owns half of Maruti. So these kinds of anomalies in the market do occur, but when they get corrected so swiftly that you are shocked with what has happened. And again, for context, the HDFC Bank market cap was made by Apple in one day. When it rises 7% on a 2 trillion market cap, that's 140 billion. So while the numbers look very large, and you say, how can any, we used to say this for Reliance, no, it's so big, it's 10% of the index, how can it go up, nobody can buy it. When it moved, it went up 4x.
But then
So these things happen, and again, I'm not making a case for any stock in particular.
Absolutely, yeah.
But all I'm saying is that the financial space has lagged this market because earning momentum has been elsewhere. It was a lot of correction which happened, and largely the excitement was PSU banks because they went from whatever 25-30,000 crore profit to almost 2 lakh crores. There was a time when HDFC Bank was equal to the entire PSU banking space.
Yeah.
That was also a reality. And today it seems to be swapping. PSU banks' profits have gone up, multiples have not gone up because still the old fear is there of telephone banking. But if the narrative of PSUs is true, that they are now run efficiently, there's no more telephones coming in from Delhi or wherever, and if we can buy HAL or BEL and whatever on 40 multiples, it doesn't stand to reason that BOB, UBI, Canara would continue to trade at 1 time, 1.2 time book or 7 time multiples. So these things will change over time, but it's as an investor, you have to have patience to, as I said, you buy mispriced odds. If you buy the horse, as Charlie Munger used to famously say, the horse which is supposed to come first, if he comes first, you don't make any money because you're betting the odds.
Yeah.
But you bet on a horse number 13, who comes number 8, you make far more money.
Yeah.
And that was the narrative for mid cap, small cap also, that they all perform better than they were expected in this upswing. But the large opportunity for money making remains in large sectors, which are large profit pool sectors.
No, but
and that's the only argument I'm making.
so that's my next question then. It's always a battle in your head, right? Momentum is making you money.
Right.
Value is not right now. So how do you approach this market? Do you wait for that turn, or do you start to position yourself right now itself,
I can
lighten yourself
let
in
me
some of the
only
momentum
drawback
stuff?
from history. So I don't think whenever we also buy stocks, we don't think it'll become momentum stocks. A lot of our stocks have ended up becoming momentum stocks. So, and Manikbhai, who's our founder, he used to say this very well. He's saying you should always be a buyer of value and be a seller in momentum. So as in you buy what is hated. Like today, if I'm holding a momentum stock, I would continue holding it because there you then start looking at technicals, that is it making higher rising top, higher rising bottom formation. So as long as it's higher top, higher bottom, it's fine, ride the momentum. But the day you see that break, don't try and convince yourself about the fundamentals of that. Then be merciless in selling. And that's what I mean, that if today you have bought a stock and been fortunate to participate in a 8p stock becoming a 40p stock. Nothing stops it being a 60p stock. It could well go there. But when it turns from 60 and it starts falling, then be merciless, because eventually this will settle at a 20p. So the speed of, like, if you are holding stocks today, and like I said, I do expect India to get into momentum territory. Don't change your horses midstream. Continue holding, because at least your cost base in what you're holding is low. So when it turns and you do sell it and you may not get the top, you don't feel and don't beat yourself up that, oh my God, I sold it cheap, or I got burnt on it, or I lost money. Because if you sell something which you bought cheap here, you will end up buying something also which is expensive, and when that falls, you're going to lose a lot of capital. So that's all I can say on that perspective. However, as a buyer, you should always be thinking, do I have a double dip in a stock where earnings can go up as well as multiple can go up? That's the logical way to approach buying.
Okay, Manish, where do you stand on commodities now? Because that's one area where a lot of people are debating whether it's a super cycle, whether we are already in the middle of a cycle, and how do you approach stocks here? Because we have the example of 2000 to 2010 when we had this massive surge in commodities.
Yeah, so it's a great question, because I think in terms of cycles, if you think after the world went to the Bretton Woods standard and they broke the peg to gold standard, we create a bubble every decade. And in the decades, if you look back from the 70s, it went into first the Nifty 50, but it then transcended and went into commodities. And that was the famous era of Hunt brothers, who made their killing in silver. And oil went to crazy heights, and it topped out in 1980. It then translates in every decade between technology or growth stocks and then commodities or emerging markets. That's typically the changeover which happens. So you take it from commodities to EMs of Japan and Taiwan in the 80s. In the 90s, you see the climax of NASDAQ, again technology. 2000 to 2010, you again saw it back to commodities and EMs like China, which led. 2010 to 2020, you'll realize India and all did nothing, China did nothing. It was back to NASDAQ and the technology shares. And because post 2008, this kind of money printing happened, they've extended the technology bull cycle. And it's an extended bull market there with excess money printing, which is going to lead to a crazy climax in the commodity complex. Which is why the bulls who are in gold, silver, uranium think the prices are not going to be 20, 30, 40% up, but multiples up. That's also been explaining a bit of the rise in Bitcoin, because these are all anti-currency bets. That if currencies are getting debased and central banks, including ours, are not interested in letting us move a lot against the dollar or the euro and so on, what is the trade which can then counter for my loss of purchasing power? And that seems to be moving away to, first of all, it'll go to all these precious metals, uranium, which has great use now in what is happening in nuclear, and eventually into commodities, because your cost of mining, cost of labor is all getting inflated up. So yes, commodities is going to give you money which I don't think even I can calculate today.
Will it create a bit of an inflation problem then for India?
It is. So India is creating a problem for itself by holding the currency down. So our currency, I believe, is being held down with the mistaken notion that it helps exports. It doesn't. Because the next morning you get a call from overseas, from your buyer who says drop your price because your currency
you're
is down.
getting currency benefit, yeah.
What you actually end up doing is importing this inflation, because you're buying oil from abroad, you're buying all these commodities. So at one level, the commodity complex and banking profitability starts becoming superb in India. And then the currency, if it falls, it gives you supernormal profit over here. But on the other side, it makes the rest of the country, which is 95% of India, which is not exporters, poorer. So today, if 2 lakh crore dividend is given by RBI to government, it's a multiple of that which was effectively lost by the Indian public, who, if the currency had been stronger, would have had a bigger purchasing power to buy goods and services. So we'll see how this plays out, because eventually that arsenal of 650 billion is not there to provide dividends. It's to provide stability and price stability to the Indian public. And I'm hopeful that RBI will be able to, as they have, manage the inflation issue very well.
Yes, that's a topic which is very close to Manish's heart, and every topic this will come out, and we can have, of course, a longer conversation on that. But one last question then. You said tripling of index every 10 years. That should be your broad horizon. We're at 23,500 roughly thereabout. So in 10 years, we're talking about 70,000?
Yeah, look, from whichever point to point you'll take, you'll go 3 to 4x in every decade. There will be periods in between where you look point to point from the high to the low and say, this is all crap and I wish I wasn't in this market. and there'll be points you'll say from bottom to top, you'll say, wow, there's nowhere else to be. Reality is the market will give you return equal to the underlying rate of return of equity which the company makes.
Earnings growth.
Which by and large is 15-20%. It can't be more than that. And that's what gives you that 4x in every decade. If you're lucky, you buy the best performing sectors and stocks, and fortunately some investors have done much better than that over time. But as an index level, if you multiply your money 3 to 4 times in every decade, that's good enough. In fact, oddly, that's the return gold has given for continuous series of decades. So it's really an anti-inflation hedge again. You have to buy equities when you think there's inflation. You can't be in fixed income. And it is a young country. We should be taking risk. We should be putting a lot more money into equities as a country. And I'm glad that the Indian public has made enormous money in the last 4 years. And that is setting the stage for this economy to grow faster over the coming decades. And as I said, the century does belong to our country. We are young. We are willing to work hard. And there's no reason that our progress can be halted.
Absolutely. Nitin Kamath, in fact, put out the data that, among his clients, they've already made 50,000 crores.
Wonderful.
And sitting on 1 lakh crores of unclaimed profit. Manish Chogani, always a pleasure talking to you. Thank you so much for joining us.
Thanks for inviting me.
Well, that's all we have on this special edition of Market Masters.
Welcome back. You're watching us here on Halftime Report. The Nifty is holding up above the 23,400 mark, but for how long is something that we'll have to see, because while it is around the higher end of today's trading range, the Nifty bank has come below that 50,000 mark, a mark which it has been facing supply at. No real problems for the mid-cap end of things, 400 points on that index, nearly 0.75%, and that upmarch continues for the 12th day running. As we speak, a lot of these industrials and, infra-related stocks, manufacturing-related stocks surging. We have Siemens, which is up 6%. A decent up move is what we're seeing on ABB India as well. Honeywell is the other one, which is up 2.5%. Bharat Forge has also surged. So all these stocks, mid-cap industrials, are doing extremely well. What we need to see, however, is where we go from here. Why do I say that? Because 23,400 seems to be a bit of a resistance, 23,400 to 23,500 on the Nifty, and we are seeing traction in the 23,400 call as well. 135 rupees available for premium, 23,500 call has about 84 rupees available for premium. So, the street believes that around 23,550 to 23,600, there could be a fair amount of resistance. At the lower level though, 23,300 is an important support. Why? Because even as the Nifty is above 23,400, we are seeing aggressive writing at the 23,400 put and the 23,300 put as well. Remember, in the last 4 trading sessions, the Nifty hasn't closed below 23,200. So obviously 23,250 would be an important support to watch out for, going just by this action on the options. A lot of long positions added on a couple of these names like ICICI Bank and ICICI Lombard rather, and Dixon Tech. ICICI Lombard, Yash did speak about the data that came in for the month of May, general insurance. Balrampur Chini is the other one I'm watching out for. Yesterday the sugar stocks were abuzz and this stock came out of FNO band. Seems like today it may go back into FNO band, so be mindful of that. And the other one is Canara Bank. That one too looks like it may get into FNO band today.
Okay, all right, Manglam. Thanks very much for that. Soni Patnaik of JM Financial now joins in to discuss the technicals of the market. Soni, welcome to the show. Well, the Nifty's already given returns of around 0.6% this week. The mid-caps have definitely outperformed with a gain of around 3.5%. What would your approach be towards specific stocks, both in the frontline space as well as the broader markets? Any picks there?
Ekta Manglam, thank you for having me on the show. In a range right now, it is going to act as a level which is going to be very important to watch out for. And, a closing below it can see some profit booking. It is better to stick to stock-specific strategy. The first stock would be in Ashok Leyland. So it is giving a fresh breakout on daily charts with a stop loss of 230 and a target of 252 Ashok Leyland. The second stock would be a sell call because it's a balanced approach in markets right now. So the sell call comes in realty space, which is Oberoi Realties. In futures, one can sell and keeping a stop loss of 1920, a target of 180.
Okay.
Right, and okay, what about individual stocks? All right, we got you there. Sorry, we lost you. connection out there. Sony, thank you for joining in. Let's speak about the automobile industry, because with the elections over, the automobile industry is actually looking forward to the government's vision document for electric mobility. Sources say a 10,000 crore rupee FAME 3 scheme could be announced in the budget. But in what could be a bigger trigger for electric transition, the government's plan for deploying 8 lakh electric buses by 2030 is back on the discussion table as well. Parikshit Luthra joins in with more on that one. Parikshit.
Well, yes, this is a mega electric bus program with the 2030 mission, which is now going to be discussed by NDA 3.0. Now, towards the end of NDA 2 government, this program was being discussed, but it did not get approval from the Prime Minister's office. Now, it's very much back on the table, and in fact, the government could move a cabinet note by September, October this year, and this could receive a green light. But currently, discussions are underway between the Prime Minister's office, Ministry of Heavy Industries, Ministry of Finance, and the Ministry of Commerce as well. So what will the 60,000 crore fund entail? The government is considering setting up a credit guarantee and risk reduction fund to cover part of the default or losses by banks in lending to e-bus operators. Currently, private operators who are buying buses and taking loans from banks have to pay a much higher rate of interest, and banks are also reluctant to lend because of fear of NPAs and losses. So the government wants to move in as a guarantor and also provide a risk reduction fund to banks. Now, this proposal is under preparation right now. What would this do? The government is aiming to deploy at least 8 lakh electric buses, 2 lakh in STUs, 6 lakh by private operators by 2030. And this is on all strategic highways across the country and key metro cities as well. And this is for 2030 in both cities and intra-city corridors. The bulk of the fund from the 60,000 program will go towards setting up charging infrastructure. There would be a rollout of a payment guarantee mechanism for charging infrastructure on strategic highways on a PPP model. So the government is hoping that with this risk reduction fund, banks would find it easier and more lucrative to lend to the private sector buying electric buses. Now, with this risk reduction fund, the government also believes that the interest rate for buying a diesel bus on loan and an EV bus on loan would be almost the same. Apart from this, there is a 10,000 crore FAME 3 scheme for two-wheelers, three-wheelers and shared mobility, which is also being discussed. This could receive a green light very soon, and this could be there in the budget as well. And FAME 3 would be period for 2 years. So these are two big things that the electric vehicle ecosystem, the automobile sector can look out for. In the immediate term, a 10,000 crore rupee FAME scheme, extension of FAME 2 for 2 years only. This would be there in the budget by all accounts. And the second, a much bigger plan, would be a 60,000 crore electric bus program, which is yet to receive the green light, but preparations on very sincerely across ministries, and a cabinet note could be moved by September, October on that.
Okay, all right. Thanks very much for that, Parikshit. So that's the update coming in on the automobile space. Well, we need to take a short break, but there are a lot of stocks buzzing around. Just keep your eye out. Just keep your eye out on Suven Pharma. That stock is in focus because it will be acquiring a CDMO manufacturer, Sapala Organics. And remember that this particular company, this Hyderabad-based CDMO company, it's a private company, is focused on manufacturing complex drugs. For example, oligo drugs, which are used for more difficult to treat diseases such as respiratory, cancer, etc. Now, it will also focus on different drug delivery compounds. So it is getting into a more complex space, which would overall in the longer term be beneficial for Suven Pharma. So the company is initially going to acquire 67.5% for 229.5 crores. In FY27, they will be acquiring the remaining. Now, FY24 sales were around 65 crores plus and margins 45%. But it compares to 85 crores in terms of revenue in FY23 and 105 crores in FY22. So there's definitely some fluctuation there. The company says the acquisition is going to be eventually, the 100% acquisition is going to be in the range of 13 to 15 times EBITDA multiple. It depends on the performance in the next 3 years. But the range that they've given that they'll shell out eventually is between 340 to around 450 crores. They expect to complete it by Q2 of FY24. The current promoter of Sapala Organics is going to continue as the CEO and run the company. He's also going to be associated with Suven Plus Chance. Suven Plus Chance is basically the consolidated entity as a strategic investor in the Japanese markets. As you can see, Suven is up around 4.7%, reacting very positively to this piece of news. We'll take a short break, but up next we will connect with Richa Singh, Managing Director, India and Middle East Natural Diamond Council, on our commodities segment. Stay tuned.
Welcome back. Joining us on the show now is Richa Singh. She's Managing Director, India and Middle East Natural Diamond Council. Richa, hi. Thank you so much for joining us here in CNBC studios. We've seen the numbers actually do quite well for themselves when you look at the last 1 year. Would really love to understand on, are Indians buying more diamonds now? Because we know that the gold prices are at an all-time high. Is diamond also actually getting taken into that rally?
Oh yes, of course. We keep saying we are Sone Pe Suhaga, so we are the cherry on the cake, and of course we are having the same run that gold is having. We are having a great year. I'm very happy to say that India has become the second largest consuming country for natural diamonds after the US. Of course, US is substantially larger, but we have become the second largest. And the consumer continues to show love and interest in diamonds, and the desirability continues to grow.
Okay, so the second largest consumer in the world now in sense of natural diamonds.
Yes.
Okay, so we do understand, Richa, that we've seen the rough diamond prices decline in this year. Also, when you look at the chart in last 1 year, 5 year, 10 year, there actually is a decline.
Yes.
Has that showed in the retail pricing as well, and has that been passed on to consumer?
So the retail pricing, if you see, it's a combination. Whenever we get any information, it's a combination of the jewelry, which is the making, the craftsmanship, the gold and the diamonds. So that's the kind of information we get. But no, the prices are up depending on who we speak to. The prices are up 5 to 10% at a retail level. So the going is good. The retailer is adding value. So yes, of course, there's a difference between the rough or the finished jewelry pricing.
Richa, I mean, as you said, that we are growing at a much faster rate, and we've seen now competing with China in sense of numbers there. But within India, when you look at the numbers, where do you see the penetration now coming in? I mean, we do understand that the metros buy a lot, but tier 2, tier 3 cities, what is the kind of ticket size that we see being spent on diamonds?
So, in fact, tier 2, tier 3 have been our biggest buyers, or most engagement that we are seeing with the consumer is higher at tier 2 and tier 3. I've just come back from Indore. A beautiful store is open there. We were privy to it, and when you see the kind of engagement that you have from a 25-year, 30-year-old, not related to wedding, but the involvement in jewelry, it's very heartening. So I think the majority potential growth is coming from there. One number I can quote is that, De Beers report just said that in 2021, the average ticket size of diamond jewelry used to be about $560. Today, it's at $1,500. So in 2 years, to see a 3x increase in the total jewelry, a piece of jewelry cost, I think it's a fantastic place to be in.
Oh, absolutely. And the season is yet to begin. I mean, that starts from the month of August. So what are you anticipating for this year now in sense of sales? I mean, I know it's still early days, but I'm sure you've done your groundwork here. You are reaching out to a lot of retailers in various cities.
So depending on the size of retailer, I think the information that we have is anywhere from 7 to 10%. Some very conservative will say 5%, but we have some ambitious retailers who are talking about it. But everybody is positive about the season. It's not, Akshaya Tritiya was a good vibe, and the growth vis-a-vis last year and the current period. So I think the retailers are looking forward to season. I think the consumer is excited about the festivities. So we are, as an industry, we are excited and looking forward to the season, gearing up for it.
And, heading the Natural Diamond Council, it does come with its challenges, I'm assuming, and especially at a time where there's a big disruption in sense of lab-grown diamonds.
Yes. So, yes, lab-grown diamonds did keep us, shake us up a little and get excitement going. They didn't let us sit easy. Lab-growns, when they came in, when I joined the industry 6-8 years ago, when it started, the growth, the difference in the pricing was minimal. It was considered to be a great deal. Today, with the production increasing, I think that the consumer is realizing the gap in price. It is not being treated as the same category. It's a different category. It has a growth potential. It will grow. It's young, so the prices will stabilize soon, hopefully. But at this point, the consumer is not shifting from one to the other. They are two parallel tracks. Both will grow, and hopefully both will have a great season.
Okay. What is it that you see as a spend coming in from India? Is it more small ticket, larger ticket? And what really is the age group which is buying natural diamonds? I mean, I do understand there are beginners and then people upgrade and exchange and buy a bigger diamond. How are you bracketing it?
So, there is a traditional moments of purchase that have always existed, whether it's milestone, birthdays, anniversaries, shadis, and shadis still continue to be the largest time of purchase. But we are also seeing a lot more of youngsters coming, and when I say youngsters, sorry, I'm saying a 22 to a 30-year-old who's coming in and talking.
They're youngsters, all right.
We are all youngsters. But 22 to 30-year-old who's coming in, buying it as a celebration or to commemorate a moment. So whether it is a promotion I got, whether it's something great I did, I bought my first bangle when my daughter was born, and it was to celebrate, saying, hey, I did it while working full time. And so my biggest, most used piece of jewelry is this, and I think that that's the new consumer. But just to tell you, we define, when you said what is it that we see movement from locker jewelry to what we call a drawer jewelry or dressing table jewelry. People are buying pieces that they can wear and enjoy, not keep for only one moment or once a year. So you are seeing a lot more things that can be paired up, worn together. Big and small is their choice, but a lot of stacking happening, or solitaires, which seem to be back, and they are the most bought. From 30 pointers up till 2 carats. You have solitaires that are happening, which is the most loved word, whether it's a 25-year-old or a 45-year-old.
I can understand that. And thank you so much, Richa, for coming by and talking to us all those numbers and the expectations, of course, from this one industry which doesn't see a downtrend ever. But as we wrap up on this edition of Halftime Report, we would like to thank all our viewers for your continued support. CNBC-TV18 recorded a viewership of 93% on counting day for the most unbiased and accurate coverage. Stock markets were reacting to the votes being counted. We had a viewership of 91%. CNBC-TV18 beat competition by a massive margin. From investors to India Inc., the CNBC-TV18's election headquarters was the go-to for election insights. Once again, we thank you for your trust and faith in CNBC-TV18.